students, this is Professor Arnold, and this is a tutorial on the bond market. What we're going to be discussing today is how the bond market works. So the first question is, what is a bond? Basically, a bond is a loan. It's a loan by the issuer of the bond, which is usually a firm or a government, to basically whoever buys the bond. So the way that you loan money to the firm or the government is you purchase a bond and they agree to repay the bond price later. It can be from a government or a firm, as I mentioned, and in terms of government, it can even be like a school district. Mesa College, all those nice new buildings that you're seeing being put up were financed by bonds. In 2015 in the U.S., there was $40 trillion worth of outstanding bonds. And bonds are also called securities. Stocks are called securities and bonds are called securities. So the second question is more specifically, how are bonds sold? What's this business about firms issuing you a piece of paper? So first we need to make a distinction between the primary market and the secondary market. Because once you have purchased a bond, you can resell it. So you may not want to keep it until the firm or government entity would pay you back for it. You might want to resell it. So the first time it's issued, we're calling it a primary market. And the second time it's issued, it's called a secondary market. Now, that's what I got when I was trying to show you guys a picture of a bond. I Googled picture of bond, and there I got James Bond. So then I Googled security, and I got this guy. So clearly, the internet, anyway, has other ideas for the terms bond and security. So I got around it by typing in corporate bond, and I didn't only get corporate bonds, I also got government bonds. And here's one from the state of Louisiana. And if you look at the date here, up towards the top, it's 1875. Is that what it is? Series 1875, payable to bearer in January 1876. 1886. It's hard for me to see. So you'll notice that this bond is worth $5. Also, this bond, besides the $5 being payable to whoever physically presented this bond in 1886, January 1st, or later, also annually they could cut off one of these little tabs. They're called coupons, and they could get a little bit of money each time, 7.5 cents, you can see. So they could get 7.5 cents every year before that. Here's another one from McDonald's Corporation, and they're calling this one a debenture. A debenture is a bond that's not secured, meaning if they can't pay it back, they're not promising you one of their franchises or anything about their business. So some bonds, when they're sold, if the company can't pay them back, then they will guarantee that you'll get a part of their business. But if they're guaranteeing nothing, you just need to trust them, then they're going to call it a debenture. So this one was due 1993. It's for $1,000. I didn't find any that hadn't come due yet, and I guess that makes sense that they would not want pictures of those being out on the internet. Here's the Republic of Ireland, bond certificate for $10. I'm not sure. Gosh, it's hard for me. This is going to show up larger to you guys, but it's really hard for me to read this screen. It's exchangeable if presented at the Treasury of the Republic of Ireland 1 month after the international recognition of the said republic for $10. Interesting. Really interesting. So that's not a specific date. It says once they're going to be internationally recognized as a republic. But it was issued on January 21st, 1920. So there are lots of these out on the internet. It's really fun. Type in corporate bond. You'll get bonds and you'll get stocks and you'll even get bail bonds. You get all kinds of these. But like I said, I couldn't get a current one, so I had to write my own. And this one is going to be paid on Halloween next year, so let's decorate this like a Halloween jack-o'-lantern, because you notice they were all decorated pretty fancy. So make this one fancy too. So company XYZ will pay $10,000 to the holder of this bond on October 31st, 2018. Today's date is October 31st, 2017. So $10,000 is the face value. That's the term that we use for the $10,000. October 31st, 2018, $10,000 goes with face value. October 31st, 2018 is the maturity date. And October 31st, 2017 is the date of issue, but we don't use that too much. So let's look at these terms again and a couple more terms. So you tell me, looking at this, what's the maturity date? If you said $10,000, you got it right. What's the, oops, you didn't get it right. If you said October 31st, 2018, you got it right. $10,000 is the face value. The purchase price, interesting. Do you see it on there? Purchase price isn't on there. And what's also not there is the interest rate, which when we're dealing with bonds we call yield. AKA means also known as. So some of your books will even call it the interest rate, but the more common and more proper term really for a bond is yield. We don't know what our interest rate or yield is until we know the purchase price. And the purchase price isn't on here. Can't forget my jack-o'-lantern. The reason the purchase price isn't on here is because we are going to sell these over and over again, remember? They're sold the first time in the primary market. They're sold later on in secondary markets. So let's take a look and do some calculations with different purchase prices and see how that affects the yield. So the formula to calculate the yield, this is a percent change formula. You've seen these throughout this semester, and we'll see more of them. So basically, the face value minus the purchase price divided by the purchase price. We'll multiply it by 100, so that we can express it as a percentage. And we'll do a few examples. So remember, we're going to go with the face value of $10,000. So let's say that Alexa purchased this bond from company XYZ. So she was buying it on the primary market. And let's say she paid $9,000 for it. Then we've got $10,000 minus $9,000, because that was the purchase price. We've got all of that divided again by the purchase price, so divided by 9,000. And we've got the entire thing multiplied by 100. Now after you do that calculation, you're going to find out that this comes out to 11%. So take just a little bit of time. Go ahead and pause if you need to, and do those calculations to make sure that you're able to get the same number. Try it now again without me doing it first for 8,000 and for 5,000. And again, go ahead and pause until you're done. And if you calculated correctly, you got 25% if she had purchased this bond for 8,000. And if the purchase price was 5,000, you would actually get 100%. It's going to double for you. These are really high. These are examples of extremely high yields. You don't see those in the market usually. So 9,000 gives us a yield of 11%, 8,000 gives us a yield of 25%, and 5,000 gives us a yield of 100%. I want you to notice something here. I want you to notice that the bond price and the yield are inversely related. In other words, when the bond price falls, the yield goes up. If the bond price rises, the yield goes down. So you can see that 9,000 down to 8,000 and 11% up to 25%. 8,000 down to 5,000, the yield 25% up to 100%. So mathematically this makes sense. If you're paying less for something, getting the same value at the end, but you're paying less at the beginning, your yield will be higher. So let's say that Alexa did buy the bond for 9,000. She has a yield of 11%. The question would be, why might she want to sell it before the year is up? And there could be a number of reasons. But for whatever reason, whatever's going on in Alexa's life, she has decided to sell it, and she wants to sell it so bad she's willing to take less. So she sells it to Samantha for $7,500. So go ahead and calculate what Samantha's yield is. If you did the calculations, you'll find that Samantha's yield is actually 33%. So in the quote-unquote real world, Alexa didn't go find Samantha and say, will you buy this? She went to a bond broker, somebody who's in the business of buying and selling these. And Samantha does the same thing. She doesn't wait for the maturity date either. She goes to Eduardo, and Eduardo buys it for $8,000. So Samantha's made some profit. Samantha's made $500. She hasn't made as much as she would make if she kept it to maturity date, but for whatever reason, Samantha wants to sell it now. And Eduardo has a yield of 25%. So the fact that bonds can be sold again on the secondary market is a very good selling point. You're going to buy more of them than you would if you actually had to keep it through maturity. That's going to help the demand for bonds in the bond market. And if we take a look at the market for bonds, let's figure out what's where, who's demand, who's supply, what's going on. If you already in your class have had the market for loanable funds, you'll remember that in the market for loanable funds, the way it's usually drawn is that interest rate is on the price axis, on the vertical axis. But generally, when we draw the bond market, we put the price of bonds on the vertical axis. So this is the price. Put it as P1. And then the quantity, I'll just call Q1. So who is demanding these bonds? Who is the demand? They could either be demanding them on the primary or the secondary market. Households, for one. I just talked about Alexa, Samantha, and Eduardo. So households, just you or I, could buy bonds. But financial institutions as well are buying bonds. Pension funds, mutual funds, insurance companies, even banks, they're buying bonds. the foreign sector is buying bonds. So anybody who believes that the yield is going to go up will buy them now and sell them at a higher yield later, or they'll keep them to maturity. Sellers of bonds we've already talked about is firms or government entities, but it's also all of those under demand. And the reason for that is because, remember again, once we buy these, we can sell them on the secondary market. So all these entities, if they resell them, are no longer the demand for bonds. They have now become part of the supply. The price of bonds is going to reflect shifts in both the supply and the demand. That's what we see in all of our supply-demand graphs. But the only one that we're going to concern ourselves with in this tutorial is shifts in demand, and shifts in demand based on the rating of the bond. I want to add something before I do that to the demand, because firms and government, the primary issues of bonds, also can be purchasers of bonds. So we've pretty much got everybody on both supply and demand. So on to this idea of bond ratings. We have privately run rating agencies in the United States that will research a company and rate them on their credit worthiness, which is basically on their ability to pay their bond back. And three of the most prominent ones are Standard & Poor's, Moody's, and Fitch. And the ratings start at AAA and they move downward. They go all the way down to D. And anything that's a BB or below are considered junk bonds. Junk bond is a common usage. People who are trading in junk bonds prefer that they be called high-risk securities. And if you buy these, you're going to get quite a high yield. So the question to think about is why? Why would junk bonds, securities that have a higher risk that the company will default, have a higher yield? Well, the demand for those are going to be lower, correct? Consider if company XYZ, who Alexa, I guess Eduardo has it now, who Eduardo owns this firm, owns this company, owns a bond of. Let's assume that it was AAA rated and it has now been downgraded even to A. Then Eduardo won't be as comfortable holding it. The demand for these bonds will go down. As Eduardo tries to sell it, actually the supply could go up as well. So I guess we will move supply and demand here. And we've got a new price and a new quantity. And we've got Eduardo trying to sell and we've got less people wanting to buy. So P2 is below P1. The price of bonds has fallen. And why does this make the yield rise? Because remember, fill in the blank. Price and yield are inversely related. What do you think the US is rated? If you guessed AAA, you're right. Although there was a short period of time when we were less than that. For the first time in our history, in 2011, we got downgraded. We got downgraded because there was a question. There was a question of whether we were going to raise our debt limit. Our debt limit being the amount of debt that the U.S. government can carry. And I don't know that it was ever a serious question, but it unnerved the rating agencies enough that they downgraded us. I want to show you a website here. Federal Reserve Bank of St. Louis. You can find all kinds of data here on all things financial. It's a great website. And so I just typed in corporate bonds. I went to search Fred and I just did corporate bonds. And you can see that they have all kinds of different rates and categories for corporate bonds. So I just selected monthly Moody's, the rating agency, seasoned AAA corporate bond yield. And let's see what the graph looks like. Let's see what the yields look like historically. Oh wow, this is really historically, this is like going on 100 years. Take a look at how high they were in 1981. Interest rates were really high in the early 1980s, and so were yields, obviously. All interest rates were high, but you know what? Let's do the previous 10 years. So we can see within the previous 10 years they were highest during the recession. And it makes sense, right? Because would somebody want to buy corporate bonds during the recession? We didn't know how well the business world was going to recover, so demand would not have been high for those. Right now they're paying about 3.63 yield. But you can see now why I said earlier those numbers of 11%, 33%, 100% were really high, because they're high even by 1981 standards. So they're exaggerated numbers. Let's go back to our PowerPoint here. And actually we're at the end. So please review this as many times as you need to. Get a hold of me if you have any questions. And that's it. Bye-bye.